Hey, thanks for joining us for another episode of InsuranceTestHelp.com. Today I'm going to go over the differences between term life insurance and whole life insurance. This is something you're going to need for your career as an insurance agent regardless. So really good to get a good grasp of it. Now for your exam, nail down those concepts that are going to be on the exam, and then just have those as your foundation for when you go to sell it. You are going to explain the difference between term life and whole life to people all the time. It's going to be really a major part of you selling life insurance. Most people do not understand what the difference is between term life and whole life insurance. So term life insurance, a lot of us have that. If you have life insurance through work, you probably have term life insurance unless you have like really powerful union that got you the greatest whole life insurance. 98% chance you've got term life insurance is the one you've got through work. It is a very inexpensive way to get you a lot of insurance, big bang, low price. Whole life insurance is your more Cadillac, your more expensive plan that lasts your whole life, that kind of builds a cash value and builds more of a investment plan. So let's get into what the differences between the two are, so you can pass your exam and also move on to being the best life insurance agent you can be. So for this video, I have two really great printables. This one that shows the difference between term and whole, as well as this one that shows term, whole, universal, and variable. They are free. They are available down below by clicking the links, and they'll help you kind of give all of the key things for the exam. So don't freak out if you don't remember everything as we go through it, okay? Term life insurance. Term life insurance lasts for a specific period of time. You're buying it for 10 years, 20 years, 30 years. If you're buying $100,000 worth of life insurance, for example, for a 20-year term, you would get $100,000 if you died within that 20-year period. If you did not die, you would get nothing, okay? Don't get all in the weeds with certain things, like there are riders to get all your premium back and things like that. If you want to get into all of the details on all of those, we have a whole video that goes over every kind of variation of the life insurance plans. Term life insurance, very simple. Lots of life insurance, really cheap price. And this is what most people are going to have, but know that it is a death benefit only. There is no cash value, and it basically expires worthless if you, there are options to renew it and things like that. But basically, if you don't die, you don't get any money. If you have a question on your exam that talks about being a pure only death benefit, you know they're talking about term life. If they talk about temporary coverage, you know they're talking about term life. And if they talk about it being the lowest cost for the most amount of insurance, you know they're talking about term life. Easy way to remember it, term life is temporary and it's a budget insurance. Lots of insurance, budget price, no cash value. Whole life, this is where you're getting more into it having more benefits, living benefits as well as death benefit. You have a death benefit, you have a level premium, you have lifetime coverage, and a cash value. It is permanent coverage. The premium is level with where you bought it. If you bought whole life insurance when you were 20 years old, you will still be paying the same premium when you are 60 years old. So you are paying like $30 a month. You'll still be paying $30 a month. Locks in at that price, and it builds cash value. So every year you get more and more and more building up in your little cash value piggy bank that you can use for anything you want. You can take it out for buying a car if you wanted to. You can pay it back to yourself. You pay, of course, the interest rate to the insurance company, but like insurance rates are super high right now, and most insurance loans, I think the payback is rocking about 6%. So you would actually be paying the principal back to yourself, and you would be paying the interest to the insurance company. So if you had a lot of cash value in your whole life policy, might make a lot more sense to take a policy loan than it would to go get a car loan right now. So it gives you a lot more investment options and a lot more sort of estate planning and financial options, because it's not just a death benefit. You have sort of those living benefits as well. If you see anything about building cash value, you will know that they're always talking about whole life. If you see anything about accelerated benefit rider, they are talking about you using your whole life policy while you are still alive but terminally ill. If you see anything about a loan option, they're talking about whole life. Those are sort of your key triggers. Anything about being a permanent policy, that's going to be whole life. Okay, basic differences between the two. Whole life's permanent, more expensive. Permanent. Term life, temporary, cheaper. So remember, whole life, permanent, and has cash value, lasts for your entire life. And I can't stress it enough. I know I sound like a broken record, but anything involving cash value, because you're going to see it on your exam, I promise you, just remember it has whole life. Term life has no cash value. Okay, this graphic is available as a printable download, or you can pause it and stop here if you want. So term life, temporary coverage, usually 10, 20, 30-year terms, no cash value, very low premiums. Obviously, as you get older, because you have to keep buying these because they expire, they get more and more expensive. It's good for short-term needs, and it's good for people on a budget. Whole life is permanent coverage. It usually goes to age 100 when you're considered statistically dead. Guaranteed cash value, so it builds cash value in your end. Higher premiums, obviously, of course. You can take loans against it. You usually get dividends from if you are in a mutual company, and it is best for lifetime needs. Final expense, estate planning, legacy. Lots of people buy this for young babies, and by the time those kids are ready to go off to college, there's quite a good chunk of cash value in there. So it's not like the best investment plan for college planning, but it's very, very inexpensive to buy whole life for children. So you will see that being actually the only option. You cannot buy whole term life for children. So when people buy child policies, they are going to be whole life, and they are very, very cheap. Okay, we're not going to get into too many of the different kinds of policies, but we are going to do universal life and variable life. So universal life, flexible premiums, cash value, it is whole life, and it has a death benefit. Adjustable death benefits, whether you're doing option A or option B, read your material so you understand the difference. Option A is level, option B is increasing. It doesn't matter which option you're in, they are both universal life. They both have flexible premiums. I think the question you'll probably see will be about flexible premiums. So if you see anything about that, flexible, think universal life, but do read your material so you understand the difference between option A and option B. Universal life has kind of a minimum and a target premium. You're supposed to be making the targets. My experience is not that with most people who buy universal life. They tend to make the minimums and then be really upset that they're underfunded. But you you do have the flexibility to kind of do what you want. So just know that there is a target premium and a minimum premium, and they have a flexibility to kind of do whatever they want in that range. Variable life, if you're moving on to the investment world, you will be selling variable life. If you are not moving on to the investment world and you are just going to be a life insurance agent, you will not be selling variable life. But you have to know it for your exam. So know that variable life has an investment account, just like all whole life insurance. Obviously, they're investing the money. That's how they make the money. But in a variable account, they use a separate account. It doesn't just go into the general account. The policy fluctuates based on account performance in the separate account. So all of the investments are invested in a separate account so they can know what the investment, how well the investments did. And the reason for that is that the policyholder bears the risk of the investment, not the insurance company. So with whole life and universal life, the insurance company bears the risk. And so it doesn't actually matter whether they make money or lose money. They owe you a guaranteed percentage. With variable, that's on you as the policyholder. I think the key questions with variable for the exam are going to be the separate account and that the risk belongs with the policyholder. The potential other third question could be the licensing requirement. The licensing for variables is dual licensing. You must have a FINRA Series 6 or Series 7 to sell variable life insurance, as well as a life insurance license. You cannot sell variable life insurance with only a life insurance license. So you have to be registered for both the securities that are going to be in a separate account as well as life insurance. So the questions are going to be either the licensing, the separate account, or that the policyholder bears the risk if you see a question on variable life insurance. If you're still not cozy on those, you might want to pause right here and just have a read through these. Kind of puts it all on one page. Term life, temporary, no cash value, cheap, best for, short-term needs. Whole life, cash value, permanent, loans. Universal life, flexible, right? Option A, option B, option A level, option B increasing. Variable life, that's going to be the investment account, separate account, policyholder holds the risk. And just because I think this one causes people to go into the weeds, limited pay whole life. This is whole life insurance where it pushes all the payments into a shorter period of time. It's not term. It just basically takes the payments that you would make over 100 years and squishes them all into 10, 20, or 30 years so you don't pay forever. I think that this one causes people to get a lot of confusion back and forth between terminal life. It is whole life, but you only pay it for a short period of time. So if you bought whole life for, say, an infant, and you did limited pay whole life 20 years, you would be done paying when they turn 20. They would keep the permanent coverage for their entire life, but you'd be done paying the premiums. It would continue to build cash value, but you wouldn't pay any more premiums for it. It would never expire. And just to recap, the two that are going to be really exam heavy: term life, most insurance, lowest cost, and it has no cash value. Know that for the exam. Whole life, permanent, cash value, loans. Know that for the exam. Those are your critical two to really know, term and whole, okay? And again, if this is still confusing, we got a whole video on all the different kinds of life insurance. And this graphic is available on our website as a free printable. You can go through it, maybe go through it and go back through this video. This graphic is also available, has some tips to watch for on your exam, just to kind of help you with the key points. I highlighted them. I'd like to say thank you to all of you for your great comments. I feel extremely grateful to those of you who have said that I helped you with your exams. That is so touching. Really hit me right in the feels and right in the heart with your kind words. So just a shout out to all of you for that. It was very touching. I wish you all the best on your exams. I hope this helped you to pass, and I will see you next time. Bye-bye.